What's up, everyone? I was trying to good morning, happy start to the week. I was trying to get onto the other camera, but now you have this really close up of my face. Unfortunately, what is behind this thing? The other camera, I don't know. It just kept going error, and here we are. Now you have a more grainy, closer version of my face. So why don't we get this week started? I hope everyone's doing well. I hope everyone had a great weekend to begin with. And today it's Monday, August 15th, and we are midway through August. It's actually insane. Summer's almost over. We got about I'd say like a month and a half left, a month left in here Toronto, and then could get a little colder. So I hope everyone's doing well to start the week. And we have a few things to talk about today. We have some news out of China. We got some inflation stuff to talk about and some retail stuff to talk about. We also have the FOMC meeting minutes this week. It's going to be a piece of information that had been prepared already, right? It's nothing necessarily new. We're probably not going to see that much turbulence out of this. We have the main event, the main FOMC that comes out on in September, at the end of September, and then that's going to really shake things up. That's where in September they're going to talk about the rate changes. In September they're going to talk about the monetary policy changes and how they're going to go forward with it. But here this week we're just going to get a lectured kind of pre-prepared speech that goes through the FOMC. So it's not going to be as turbulent necessarily. I don't think that people are going to wait too long for this one. It's not going to be like the other ones where it's like a week in anticipation, where Monday, Tuesday, and then the majority of Wednesday is just kind of dull. I expect not to happen this week around with these FOMC meeting minutes. But the first thing that I do want to talk about is China. So interestingly enough, in the midst of rate hikes everywhere, and we're seeing a cut of money supply, we can travel over to China and see that they've actually lowered two key lending rates and injected actually more cash to the economy, which is quite the opposite of what's going on in terms of other economies, right? We've seen the ECB and the US do it, right? Very, very large economies, and China's economy is massive as well. And instead of hiking, they're actually taking precautionary steps to actually inject more cash to its economy on Monday, as it looks to keep stimulating the economy rather than what we're seeing in other areas where we've seen quote unquote strong economies in the US, which is allowing all these rate hikes and this QT to actually unfold. So China remains the global monetary policy outlier, with the rest of the major economies actually tightening based on an effort to actually control inflation. But the People's Bank in China actually cut its 1 year lending facility rate by 10 basis points to 2.75% and cut the 7 day lending rate to about 2%. So the PBOC added 2 billion yuan through 7 day reverse repos. And economists also had expected that the 7 year rate holds steady, but policymakers are still clearly worried about the risk to the downside with strict COVID policies and weakness in housing, even though plenty of liquidity is stroking inflation pressures. So later in the day, the government also reported a batch of mostly disappointing economic data. So that has to do with the ability to actually get into a easing perspective, if you will, right? Because a lot of if you compare it to the U.S. again, a lot of that tightening and a lot of that cut in money supply is actually coming from stronger economic data. So China July industrial production rose about 3.8% year over year versus the 4.6% expected, and slightly lower than the 3.9 figure that was reported in June. Retail sales also increased 2.7% in July compared to the same period in 2021, below the 5% forecast. So, in addition, China jobless rates from 16 to 24-year-olds hit 19.9%, and this is the highest ever recorded. And the new housing prices are actually down just shy of a percent, about 0.9% year over year versus 0.5% in the prior. So the Shanghai Composite was actually flat, and the Hang Seng was down 0.5%, with China bond yields lower. And we can also see the question still remains, or sorry, I should say the question is no longer whether we can get a rebound in the Chinese economy, but how much of one, says Morgan Stanley. Now, COVID zero policies are already slowly easing, and we think that more relaxation will follow the Party Congress in October. But will freedom of the mobility be enough to reverse the challenges of the housing market? So that's one of the main things. if we take a look back at this, right, it's been years now that we've seen all these reports and these. Even there's some documentaries about these housing markets in China where there's actually just full cities with these empty apartments. They're just uh, aggressively thrown up with really no sales or really no. They're all just vacant at that point. Um, Recent policy action to address the housing crisis will help, but I fully expect that a much larger package will be needed. Ultimately, consumer and property confidence um, will need to make a rapid recovery if a rebound will take shape. So this is one of the economists at Morgan Stanley that's been talking about this China event. Now, if we look at the U.S. right and the inflation, because we had a lot of inflation data last week that actually brought the market up, right? Because a lot of people have been looking at this and seeing, okay, well, we're actually cooling off these numbers. But like I said last week, you have to take into consideration what numbers within the whole report are cooling because there's different sections, there's different areas, right? There's shelter, there's groceries, food, there's also energy, gas, and a lot of these make up that inflation, that CPI and that PPI data. So July's consumer price index and producer price index started to show some relief in rising prices, but the US economy is still far from the Federal Reserve's 2% target, right? We reported CPI and I think I remember the CPI better number better, but we reported 8.5% CPI, and I believe the PPI, might lie to you here, but I think it was about 9.4%, which was down from the expected 10%. Again, very, very aggressive. And these have to drop significantly to meet that 2% target rate. Now, 1 month, right? I can't repeat this enough, but 1 month of cooling is not necessarily the be all and end all. It's not going to just turn from here and down we go, right? You're going to have to see an average of 3 to 6 months actually start that cooling, and we have to be below that average to actually see that these pressures are off, so that the quantitative tightening cycle and also the rate hike cycle can diminish a little. Now, naturally, last week we saw that instead of a high chance of 75 basis point hike in September, we're looking more towards that 50 basis point hike. Now, keep in mind, we have over a month until that report comes out, until we have that news event. So it's going to be very important to see how that shapes up. Um, a lot can change within that month, right? We have another data point from inflation that comes in before, right, in September, before that actual report comes out. So that could drastically change things. If we all of a sudden get a hike, right, and a rise in inflation based on maybe the energy price actually coming back up, then you're going to see um, a more definitive PPI and CPI. Because remember, energy prices were down pretty aggressively over the last month, over the last 2 months or so, and that put a downside pressure on gas, which was a larger contributor to this inflation data. So much of this relief, like I've said here, has been from lower gasoline prices. The bad news is still um, the stickier prices, like shelter costs, continue to rise, food costs continue to rise. So this month to month, a 0% increase is better than what we've seen naturally, but still a lot of worrying in the underlying trends in inflation. So one of the most troubling things that I don't think got enough analysis was the food costs. And global upward pressures in grain prices is fueling back the good prices. Uh, we have to take a look at this from a larger scale as well. So again, we're gonna have to see how this shapes up realistically in the coming month and the months to come. It's not just one data point, right? We have to change things up, especially with the whole heating situation and the gas situation in Europe. That could have an effect on the global demand. Now, those could bring energy price up in the winter periods, and who knows, maybe inflation comes back up, and then we're not actually subduing that whole thing. So, in terms of retail, we got some retail data that comes out this week, but also we have to take a look at some of these sectors, or yeah, some of these sectors, and also some of the individual names as well. So bad news for major retailers is likely to continue flowing into the second half of 2022. This is again according to Morgan Stanley. And while consumer discretionary stocks have underperformed in 2022, the sector has surged as of late. So XL, why this the consumer discretionary sector from the SPDR, right? Spider. It's ripped about 20% higher in the past month as bulls have pounced on signs of weaker inflation, or peaking inflation, if you will, and improving modestly consumer sentiment. But retailers, of course, have been major beneficiaries of the swift sentiment shift. So, in a note to clients, previewing Q2 and second half results, according to hardline retail ahead of a busy earnings week. Equity analysts across the board, right? Morgan Stanley, whatever you want, Goldman Sachs, all those guys have advised that the sector's rally may be short lived. And they've also observed that about half of the companies in the coverage have already cut guidance this year. Now, it's not just them, right? We've seen that guidance has been cut across the board pretty much, mainly, right? There are a select few that haven't done that yet. Yet, despite the preemptive move to temper expectations, we can see a almost inevitable negative revision coming in this earnings week. So only the dollar stores, to a lesser extent, right? We've also seen Home Depot appear relatively weak, I would say, in Q2. For the rest, the potential downward revisions, even from companies that have pre-announced, can be a possibility, right? Retailers such as Dollar General, Walmart, AutoZone, driven brands have a buy rating for most of these big banks, and we should be cautious about discretionary names such as Target, Best Buy, Williams Sonoma, and there's much, much more. So the retail data, right, it doesn't reflect the consumer sentiment, which is a larger part of or a large part of the GDP and economy. So those are things to consider as well. It's not only the employment aspect. Remember, a lot of big companies have been cutting jobs or actually freezing hiring at least. And now with the retail side of things, right, we're getting a little more into that consumer mindset. So we'll see how this shapes up. Realistically, we've talked about inflation in the U.S. Peaking numbers. What we actually have to look at. We talked about China as well. China actually easing while everyone's tightening for certain reasons, and it's just a mishmash everywhere. So we'll see how a lot of this macroeconomic data comes out and what the effect is. Realistically, if we talk a little more about the technicals and the order flow of the general market, we've seen a little peak just here pre-market. I haven't checked it since I've been talking to you guys, which seems to be a while now. But give me 2 seconds here. So we've bounced off a very, very pivotal level. If you're on our Discord, you would know that 4250 to 48. That's like a massive, massive zone. We have to hold that today on the S&P futures, 4248, 4250, right? 2 point area. We have to hold that for the bulls realistically. If we accept under that, we manage to close well below that, then there is going to be that anticipated move to the downside. There's still a net delta position for market makers that does lean a little more towards that 4300 area on the futures, just the general S&P. And we could see how some of that shapes up to start the week, right? So again, still very strong bullish trend. I don't really anticipate it turning unless we see a large shift in structure, and that starts to get accepted under about 4200-ish on the S&P futures, because that is a huge level where there is still positive delta positioning from market makers. However, it is one of the last thresholds where we could actually start to see prices actually come down and market makers reposition that whole thing. And if you're with us at Trade Pro Academy, we have weekly reports talking about the macro stuff, just the overall stuff, and we follow the COT report very carefully. And if you take a look at the commercial paper, right, you go to bar chart or whatever, bar chart COT, type that in Google, you'll find it there. But you take a look at the commercial paper, and it's been very, very aggressive since about like mid-June. Now, the commercial paper buying, right, until that turns around and we actually go negative or actually get a stronger slump to the downside, there isn't necessarily that much weakness in the market, right? The inflows are still coming in tech names, in growth sectors, right? So we have to keep an eye on that until those things shift and money is actually outflowing out of this market. It's going to be very difficult for this thing to turn around. But another thing to mention before I jump off here, we've talked a lot today, is that you have to take a look at the general volume and consider what kind of seasonality we're in, because July and August, realistically, there's not that much institutional money pouring into this market, right? A lot of people are on vacation. It's a very, very similar event to what had happened with the quote unquote Santa Claus rally in December, right? It's a little different. Naturally, it's not as aggressive. December was not as aggressive as now. But again, we have to keep in mind that when institutional money actually comes back to this, then we'll see what the next real potential move is. So keep that in mind. Keep those levels in mind. Hope you have a great start to the week. Happy trading. And we'll see you guys when we open our live rooms for both options and futures. And I'll see you guys tomorrow. So thanks for joining us today. Remember, check us out at TradeProAcademy.com if you guys want to see some my brain stopped there. If you guys want to check out our master classes for futures and options, right? we'll show you guys some interesting strategies in there. But other than that, we'll see you guys tomorrow, and we'll chat soon. Thank you all. Thank you for joining me. Thanks for the comments. I read them as well. Appreciate it, everyone. Technical analysis, Ian, Levy, Sam, Dave, everyone. Hope you're all doing well. Thanks, Barbara, and we'll chat tomorrow.